Hello students, welcome to Lokayan IAS Academy. I welcome you to Lokayan IAS Inside PYQ series of subject Indian Economy. Until now, we have discussed external sector, inflation and monetary policy. Now, in this lecture, we will be discussing questions related to budget and taxation from 2011 to 2022 UPSC Civil Services Prelim. As you know, we are not just going to discuss the questions, but we will also discuss interlinkages, expected upcoming themes, and other important stuff. So let's start. See the first question. With reference to India's decision to levy an equalization tax of 6% on online advertisement services offered by non-resident entities, which of the following statements are correct? First statement, it is introduced as a part of Income Tax Act. Second, non-resident entities offer advertisement services in India can claim tax credit in their home country under the double taxation avoidance agreement. Okay, we have to choose correct statements. See, first one, it is introduced as a part of Income Tax Act. First one is wrong because introduced as in Finance Act. Okay, first statement is wrong. Second, non-resident entities that offer advertisement services in India can claim tax credit under double taxation avoidance agreement. See, in inflation topic we will discuss that such statements like inflation index bonds have given tax exemption, etc. generally wrong. And here also the statement is very vague and too far. See, why would government give them incentives so that they can claim tax credit under that 200 DTA, double taxation avoidance agreement? So second statement is also wrong. So answer is correct answer neither one nor two. Okay, let's see next question. Okay. See, consider the following item: cereal, grains, hulled, chicken, eggs cooked, fish processed and canned, newspapers containing advertisement material. Which of the above items are exempted under GST? See, relatively, this is a tough question. 2018. See, we have to choose items which are exempted from GST. It is very hard to memorize entire list. But what we should have relative idea. See here, fish, processed and canned. This is a little bit commercial. Okay, so it cannot be exempted because trade and services is included here, involved here. This cannot be exempted. Okay, so whenever there is 3, eliminate it. Okay, so remaining options are A and C. Now see, cereal, grains, hulled. Okay, see, we do not need to consider first because that is obviously correct because we can derive it from options. Now read second, chicken, eggs cooked. Can it be exempted under GST? Tough one. The fourth one, newspapers containing advertisement material. Will it have exemption? See, I'm just not giving you answer for sake of giving answer. I'm telling you the difficulty of the question. Solving this question in exam tension is very difficult. See, this can be exempted, chicken, eggs cooked, because it is not mentioned here that in the hotel, chicken, eggs in home, hotel, etc. specific things. You can take risk here. Second, so second one and option involving 1 and 2. So only C, 1, 2 and 4 is the correct answer. We might think, how can it be possible that newspapers containing advertisement material is exempted under GST? But that's true. Fourth item is exempted. See, merely knowing answer is not important. What you have to remember that this item newspapers containing is exempted, also look for other items which are exempted, which we will see in next slide. Okay, because this theme can repeat in upcoming examinations. Okay, so answer is 1, 2 and 4. Okay, next question on GST. See, read what are the most likely advantages? Highlight the word advantages of implementing GST. Okay, first statement, it will replace multiple taxes collected by multiple authorities and will thus create single market in India. Okay, now read second, it will drastically reduce current account deficit of India and will enable to increase its foreign exchange reserves. Okay, third one, it will enormously increase the growth and size of economy of India and will enable it to overtake China in the near future. Now see, first one is it will replace multiple taxes collected by multiple authorities and create single market. That's the core purpose of GST. First statement is correct. Now read second, it will drastically reduce current account deficit of India and will enable to increase its forex. So argument can be given that due to GST, ease of doing business will be increased because there is a single tax. So there will be more business, more export and more forex reserve will come India. That is too far statement. Okay, so prior to discussing second, let's move to third statement. See the third statement, it will increase the growth and size of India and will enable to overtake China in the near future. See, this keyword near future makes the third statement wrong. Third is wrong. Eliminate 3. So answer is 1 only. So second statement is also wrong. It will drastically reduce current account deficit of India and will enable it to increase its forex. Too far and vague statement. So eliminate this one also. And C, overtake China in the near future. What is the current GDP of China? Almost $17 trillion and India's 3 to 3.5 trillion dollar. Is it possible to overtake China in the near future? Very unlikely. Third statement incorrect. Just eliminating third statement, you can reach to answer. That is statement 1 only is the correct one. Now, as I mentioned you in starting of the lecture, that we are not just solving the question but also discussing interlinkages and upcoming important themes. So let's discuss GST from that perspective. See here. Okay. See GST. GST has 3 subcomponents: central GST, state GST, integrated GST. Intrastate trade. Intrastate trade, CGST and SGST. And whenever a trade will be interstate, integrated GST. Okay, integrated GST will be divided between central and states. In which state? Suppose goods are manufactured in Maharashtra, Mumbai, and exported to UP, Uttar Pradesh. So which state will receive the half of the integrated GST? It is Uttar Pradesh, because GST is destination based tax. Okay, destination based tax. Where consumption will happen, that state will have 50% of IGST. And the largest share is of IGST, integrated GST. Okay, so keep this point in mind, remember this. See, okay, not everything is important, just read this one. The tax will be levied on every supply of goods and services. The center would levy and collect CGST The state would levy and collect SGST on all transactions within a state, which I explained you earlier. The center would levy and collect integrated goods and service tax. So a question can arise, who will collect IGST? Answer is center. So this is screenshot from PIB, very authentic source on all interstate supply of goods and services. Okay, that's enough for IGST, CGST, etc. Now let's see one more important aspect of GST. See, this is the goods it will introduce. This is the list of taxes which were subsumed by GST. So there can be a question, which among the following taxes are subsumed by GST? So just a broad idea regarding the taxes. Okay, central excise duty, additional excise duty, service tax, surcharge, cess, VAT, entertainment tax, luxury, additional customs duty, gone. Take a screenshot and read this. Now one important concept regarding GST, that is revenue neutral rate. What is the revenue neutral rate? This is that rate of GST at which there will not be any loss of collective revenue to states and center. Suppose prior to GST there are various taxes and we had collected certain amount with that taxes. Now after eliminating those taxes we brought GST. So that rate which will give us the same amount of tax as of earlier taxes, that rate is revenue neutral rate. Suppose with earlier taxes we collected 100 crore. Now we have to choose such tax rate of GST which will give us revenue of 100 crore, that is revenue neutral rate. Okay, this is revenue neutral rate. Now just see the slabs, various slabs under GST. 0%, mostly agricultural produce. Okay, mostly agriculture. We see in the option cereal, grains, hulled. Okay, so that is also exempted. 5%, 12%, 18% and 28%. 28% is applied on luxurious good and it is meant for compensation cess to the state governments. Okay, regarding what is compensation cess and etc. we will discuss in next slide. Okay, for right now let's go through this list of exempted taxes, concept of revenue neutral rate, the various slabs. Okay, because GST is important topic and question can come in upcoming prelim examinations. Now see here, trend, very important. So remember, see here again, state GST collected by state government, CGST central government, IGST central government. Important point. Okay, take screenshot. You can take each screenshot. Now see the trend, very important thing. See again, I am emphasizing you do not need to remember exact facts and figure. Just have a brief idea. See fiscal year 2020-21. 32,000 crore in April month to 90,000, 87,000, 1,05,000, 1,15,000. Okay, now see 2021-2022, 1,39 crore, 97, 92. See what we can derive, that is there is a fluctuating trend, fluctuations. Okay, next question. In next question you will see UPSC generally asks question like tax to GDP ratio is consistently increasing last decade. The same statement can be given related to GST, that is GST revenues are consistently increasing over last 5 years. Is it consistently increasing? No, there is a fluctuation. So in April 2020 to 2021, 1,39,000 crore, 1,16,000 crore. There is fluctuation, and even in this fiscal year also there is fluctuation. So what you have to remember, GST collection trend has fluctuations. Okay, so these are the important points related to GST. Because everything we cannot cover in our this current series, because this is not specifically related to economic, specifically related to taxation and budget, because we have to cover other aspects also. Okay, let's move to next thing. Okay, GST Council. So prior to discussing GST Council, I have attached the screenshot of 2017 UPSC prelim questions of Monetary Policy Committee. The question pertaining to Monetary Policy Committee were solved in our previous lecture of monetary policy. But again, I have attached the screenshot here to demonstrate you how UPSC asks questions. It decides RBI's benchmark interest rate. Okay, it is a 12-member body and it functions under chairmanship of. Okay, so these aspects you have to look for bodies. Like there is a question in 2071 Financial Stability Development Council under chairmanship of etc. Chairmanship is important. So GST Council key features, it's a constitutional body. Okay, first one is constitutional body. Under the chairmanship of Finance Minister, so Union Finance Minister. So remember this thing is very crucial, because UPSC can give you statement like statement based question and say that GST Council is officially headed by President of India or Prime Minister, but that's not such case. Now, what are other members? Revenue Ministers of states and Union Territory of Delhi. Okay, Revenue Ministers. States. What is the voting pattern? 1/3 vote to center and remaining 2/3 to states. 1/3 to center, 2/3 to states. Required quorum 50%. Quorum 50% and 75% of votes are necessary for making a decision. 75% of voting. It is 3/4. So what you can judge from this statement, 75% voting is necessary. The center has 33% voting and states 67%. Center has virtual veto in GST Council. See, if all states come together and decides on rate, but center is not agreed upon it, center can veto it. So 75% voting is necessary, virtual veto you can say. Okay, so this is regarding GST Council, very important from upcoming exam. Now see this very important event from our examination point of view. GST compensation cess extended till March 2026. Very important from federal relations perspective. See, this is screenshot from The Hindu, June 25, 2022. That is after 2022 prelim examination. So, what is compensation cess? Let's briefly discuss regarding compensation cess. See, for rolling out of GST, states give away various taxes, VAT, sales tax, etc. So, there was apprehension among states that would GST give us the same amount of revenue which we used to get earlier with our taxes. So, center come up with idea of compensation cess. What is this compensation cess? Let's understand briefly. So consider, so the base year is 2015 and 16. So under compensation cess, it is assumed that state will have 14% rate of increase in tax revenue after accepting GST. And if there is a shortfall in this revenue, then center will pay for it. Okay, let's understand through example. Suppose state of Maharashtra in 2015 and 16 has a revenue of 100 crore rupees. Just for explanation, I am taking this figure 100 crore rupees. In 2017, here Maharashtra as a all over India there is a GST implementation. Now in next financial year, as for 14% growth rate, what should be revenue? 114 crore. So due to some issues, Maharashtra government is able to collect revenues worth of only 107 crore rupees. Okay, so there is gap of is 7 crore. So this 7 crore will be paid as a GST compensation cess by central government. Okay, GST compensation. This is the idea of GST compensation cess. See this article, GST compensation cess extended till March 2026. Okay. This is GST compensation cess. Let's see next thing. Okay. So again, important thing. The term base erosion and profit shifting. It's sometimes seen in the news in the context of mining operations by multinational companies in resource rich but backward areas, curbing of tax evasion by multinational companies, exploitation of genetic resources by country by multinational companies, lack of consideration. What is the answer? Answer is, before going through answer, let's see this question. This is a question from 2016 and this question is from 2010. A great deal of foreign direct investment to India comes from Mauritius than from many major mature economies like UK and France. What is the reason behind it? India's preference for certain countries as regard receiving FDI. India has double taxation avoidance agreement with Mauritius. Most citizens of Mauritius. What is the answer? This one is, India has double taxation avoidance agreement with Mauritius. Similarly, is base erosion and profit shifting is curbing of the tax evasion by multinational companies. They carry out these practices through various means like round tripping, treaty shopping, transfer mispricing. Okay, this one is very important because I will see in next slide, because recently G7 countries had a consensus on global minimum corporate tax. Why? Because various MNCs are evading tax worth hundreds of billions of dollars. Okay, so let's understand. Double taxation avoidance agreement, DTAA. Okay, suppose in India we have a company Tata Motors. Also we have a company X from foreign country. So in foreign country there are branches of Tata Motors. Also this foreign country is home country of company X. Now under regular conditions, the company X has to pay taxes in India also and home country also. In same way, Tata Motors has to pay taxes in India and foreign country. So this will affect the ease of doing of business. So to avoid this, companies countries sign double taxation avoidance agreement. Okay, so this DTAA is misused by various MNCs like company Hutch entered India, but its registered office was in Cayman Island. So Vodafone Idea bought the shares from Cayman Island, and the value of those shares received their value of those shares depended substantially upon the assets located in India. Okay, so this is DTAA. Now see various important various malpractices of MNCs. Treaty shopping. What happens in treaty shopping? A company, investors establish company in tax havens. What is tax haven? Where there is a very minimum tax, almost a nil tax. Okay. Now this company in tax haven opens its subsidiaries in India. Subsidiaries in India. Okay. Now this company operates in India but is registered in tax haven country. This company has substantial assets in India. Due to tax avoidance agreement between India and the foreign country, it doesn't have to pay taxes in India. It has to pay taxes in its tax haven, that is the original country, where there is a minimum tax, almost nil tax. So India misses the taxes. This is treaty shopping. Another one is round tripping. See what happens in round tripping. Suppose there is a capital in India and we establish a company. So we have to pay taxes as per the Indian tax rates. Okay, so that is maximum. So what happens is round tripping, that Indian capital goes out either legally or illegally. Capital goes out specifically in tax haven. Now what happens? Tax haven, a shell company is established in that tax haven and opens subsidiaries in India. Now, as soon as subsidiaries open in India, but the company registered in tax haven, so it has to pay taxes in tax haven, which is nil. So again, taxes are evaded. It is round tripping. And another is transfer mispricing. In transfer mispricing, artificial payments are made between intra firms, sister firms. Okay, why? Because these transfer payments made are artificially priced very high, due to which profits are reduced, and due to which the taxes upon the profits also reduce. So question can be asked simple like the terms round tripping, treaty shopping, transfer mispricing often mentioned in news are related to. So answer is tax evasion. So again, why I took this topic? See, this is a screenshot from The Hindu. Center ratifies convention to curb company profit shifting. Read this. Government announced that it had ratified international agreement to curb base erosion and profit shifting in a bid to stop companies from moving their profits out of the country, depriving the government of tax revenue. India had ratified multilateral convention to implement tax treaty related measures. Take screenshot of this and read. Another important, the MLI result of concerted work by G20 countries. See, right now India is president of G20. This become important. Okay, so MLI, important keywords: MLI and G20 and OECD. So go through them carefully. Next question. Okay, see there, conceptual question. A decrease in tax to GDP ratio of a country indicates which of the following? Again, it won't happen that you read this somewhere in your sources and encounter this in exam. On such question, you have to think in exam hall itself. Okay, see, tax to GDP ratio, tax upon GDP. What is given in question? Decrease. Suppose there is x upon y, basic mathematics. X upon y will decrease when this y will increase. As soon as denominator will increase, the whole thing will decrease. So we have to choose the correct ones. What is the reason of this? The tax to GDP ratio is decreasing. Okay, this one is decreasing. So obviously GDP is increasing. So first, let's go statement by statement. Slowing economic growth rate. See, economic, again in last lecture, in a topic of inflation, I think I explained you difference between recession and slowdown. Slowing economic growth rate. So there is a slowdown. Okay, so growth rate is decreasing. So there is increment but slow. Okay, GDP growth rate, overall GDP is increasing but the growth rate is slow. So what does it signifies? That the GDP growth rate is slow means what? Currently there are less economic activities in the economy, and due to less economic activities there is less tax collection. So under the first situation, GDP will increase but taxes will reduce. So will it lead to decrease in tax to GDP ratio? Obviously, the denominator is increasing and taxes are reducing. See, nothing is again that taxes are reducing, but we can assume that, we can derive that, see, growth rate is reducing, obviously taxes will be reduced because growth activities, economic activities are reduced. First one is correct. Second, less equitable distribution of national income. It's a far-fetched statement. Merely with reduction in tax to GDP ratio cannot conclude this situation that there is a less equitable distribution of national income. Second is wrong. So answer is one only. So understand this question carefully. Okay, so what is keyword? Slowing of economic growth rate. There is possibility that you can misinterpret it as contraction. Like GDP is reducing. So you can say that here is economic growth is slowing, so GDP is decreasing. So tax to GDP ratio will increase. No, that is not the case. Okay. Next question. Oh, sorry. One important thing regarding tax to GDP ratio. Take screenshot of this. Okay. Now see. What is India's tax to GDP ratio from 2011-12 to 2020-21? Again, no need to memorize all figures. Just have a relative idea. See, India's tax to GDP ratio is fluctuating between 10% to 11%. 10 to 11%. Okay, so you have to remember this thing. This India's tax to GDP ratio is low. Okay, in developed countries it is about 25 to 30%. This is the share of taxes. Direct taxes has large share as compared to indirect taxes, 4.9, 5.9. But there were some instances where both of them has contributed equally. Okay, so understood this broad classification. Now see, share of composition of taxes is from Union Budget document. Very important, because question can be asked like arrange the following taxes in increasing or decreasing order, or question like GST is the maximum contributor in the tax revenue. Okay, see GST 29%, then comes corporation tax 25%, income tax 25%, and other taxes, union excise duties, customs, etc. This is a year earlier, but right now as per recent news and etc. trends, income tax, GST is 29%, 25% income tax and corporation tax. Okay, now I think there is corporation tax and income tax are not equal. We have to wait for this year's budget document to conclude this. But remember this, GST is the maximum contributor. This one again important. Contribution of taxes. Okay, see, GST 2.8%. So question can be asked like contribution of GDP in overall tax is increasing consistently over a 5 year. Will it be correct? There is a fluctuation trend, 2.6, 3.1, 2.9, 2.8, 2.8. Okay, now see this orange one, CIT, corporation tax. 2.3, 7.5, 2.7, 2.3, 2.5. Okay, take a screenshot. This is from economic survey previous year, because this year's survey yet to be published. Again, have a broad idea. Okay. Next question. Okay, which one of the following is not the feature of value added tax? Very simple question. It is a multi-point destination based system of taxation. It's correct one. It is a tax levied on value addition at each stage, correct, of transaction in the production distribution chain. It is a tax on final consumption of goods or services and must ultimately be borne by consumer. Correct. D. It is basically subject to the central government, state government are merely facilitator, or is successful answer. Wrong one. Answer is D. You have to just eliminate option. Okay. Now, before discussing further questions, knowledge regarding capital account, revenue account is important. So, before discussing question, we will build a foundation regarding capital account and revenue account. If you are well versed with these accounts, you can skip this part and go to question solving directly. Okay. See, capital account and revenue account. Revenue account and capital account. Okay. Under revenue account, we have two heads: expenditure receipts. Tax receipts non-tax. What are the major components of revenue expenditure? Expenditure incurred by state which will not result in asset creation. So, various interest payment, grants to state governments, salaries, pensions, defense expenditure, etc. These are our revenue expenditure. Okay. Or receipts, revenue receipts. So what is the key idea? Revenue expenditure is that expenditure which will not result in creation of assets. Now revenue receipts, two types, tax receipts and non-tax. What are the tax receipts? Tax revenue through GST, income tax, etc. And what are non-tax revenue? Interest, because often central government gives loan to states, it receives interest. Okay, then dividends from PSUs and sale of goods and services. Which goods which goods can state sell? Goods and services through PSUs. Okay, so anything sales of goods and services. Understood? This is regarding revenue account. Now let's come to capital account. Expenditure. This capital expenditure, that expenditure incurred by state to create assets, like asset creation, infra creation, capital. This is capital expenditure. Now capital receipts. See, before seeing the capital receipt, let's see what is the key characteristic of capital account. See, in capital account, liability will increase or there will be reduction in assets. The receipts are of two types: debt creating and non-debt. Debt and non-debt. So debt creating receipts are various from loans taken by government, loans, debt, borrowings. What are non-debt? This investment. Okay, remember BPCL example. Okay, so that's brief about capital account and current account. What I told, whenever there will be reduction in asset or increase in liability, that is capital transaction in a receipt. Okay, in revenue expenditure, no assets are created. Okay. See, this revenue receipts and capital receipts. So in revenue receipts, we are earning income through taxes. So taxes, is there an increase in liability? No. Is it assets are reduced? No. This is a revenue receipt. Okay. In this way, remember things, because you cannot remember. You shouldn't by heart this thing. Revenue expenditure, that expenditure which will not result in asset creation, and revenue receipts which will not reduce our liability, which will not increase liability or reduce assets. Now let's solve. See, this is a screenshot from NCERT. This is old economics chart 2005-6, but we shouldn't bother about it. We have to focus on first chart. Revenue receipts, tax revenue, non-tax revenue, revenue expenditure, interest payment, major subsidies, defense expenditure. Revenue deficit 2 minus 1 is expenditure minus receipts. Now see capital receipts, recovery of loans. Okay, other receipts mainly by PSU disinvestment, borrowings and other liabilities, and capital expenditure, plan expenditure, non-plan expenditure. Okay, this is 12th macroeconomic NCERT. Go through the chart carefully. Okay, this is latest one. Again, it has following components. No need to mug up figure. Just see the primary deficit, fiscal deficit, and other components. Okay, this is from budget. Now come to questions. See, which among the following are included in capital budget of Government of India? First one is expenditure on acquisition of assets like roads, building, machinery, loans received from foreign governments, loans and advances granted to the states and union territories. Which of them are under capital account? All of them, 1, 2 and 3. Okay, see here. I have explained you it here. Capital account, asset creation, asset creation, or reduction in properties and increase in liability in the receipt part. Now see the one interesting thing. Whenever central government extends loan to state government, the principal amount which center receives is capital receipt, and the interest payment which center receives is revenue receipt. So remember this thing. Okay, so that's why third one is correct, second correct, first one is correct. Answer is 1, 2 and 3. Various budget deficits. Okay, now we again building foundation for deficits. We see capital account, revenue account. Revenue deficit. This revenue deficit, revenue expenditure. Minus revenue receipts. Okay, this is revenue fiscal deficit. Now pay attention here. Fiscal deficit is total expenditure what is total expenditure? Revenue expenditure plus capital expenditure. Total expenditure minus revenue receipts plus non-debt creating capital receipts. Non-debt creating capital receipts. This is fiscal deficit. Which thing we have to eliminate or exclude? Debt creating receipts. So we will get fiscal deficit. So overall what we can derive, that fiscal deficit is nothing but the borrowings of the government. See primary deficit. What is primary deficit? Fiscal deficit minus interest payments. This is primary deficit. Now another important thing, effective revenue deficit. Sorry. Effective revenue deficit. So what is effective revenue deficit? Understand? We have to reduce, exclude from revenue deficit those grants utilized for capital creation. Grants utilized for capital creation. Okay, see, the grants extended by central government to states falls in which category? Revenue expenditure. But suppose if that grant is being utilized by state for further asset creation, so those grants we have to exclude from this revenue deficit. So what we will get? Effective revenue deficits. Okay, so this is all about various deficits. Now our foundation is created. Let's solve the questions. Okay, see. There has been persistent deficit budget year after year. Which actions of the following can be taken by government to reduce the deficit? See, specifically it is mentioned. It isn't mentioned that there is a fiscal deficit, primary deficit, revenue deficit, etc. We have to generally solve the question. Generally, what is what do we have to do to reduce the deficit? Two things: reduction of deficit, reduction of deficit. What we have to do? What is the formula for deficit? Formula means general expenditure minus revenue. So we have to reduce that deficit. So either we have to increase our expenditure or we have to reduce our expenditure or increase the revenue. These are the two strategies. Now keeping this in mind, solve this question. We have to reduce budget deficit. First step is reducing revenue expenditure. Second, introducing new welfare schemes. Third, rationalizing subsidies and reducing import duty. Correct answer. Expenditure reduced. Reducing revenue expenditure. Correct. Introducing new welfare schemes. Will it reduce expenditure? This will increase our expenditure. This one is wrong. Rationalizing subsidies will reduce expenditure. Reducing import duty, it will reduce our revenue. So fourth one is wrong. So answer is 1 and 3. C is the correct answer. Next question. See, the earlier question was asked in 2016. Now this question asked in 2015. See the similarness. Okay, theme again repeated. Persistent deficit year after year. What we have to do? Reduce it. Again revise it. What we have to do? Reduce our expenditure and increase our revenue. Even barring one option, all options are also same. First one is correct, second one is incorrect, third is correct, and fourth, expanding industries. See, expansion of industries is required to incur as government more expenditure. Fourth one is incorrect. Correct answer is asked. Answer is A, 1 and 3. This is the benefit of solving previous year questions. Okay, now see the trend. Okay, So 2020-21 fiscal deficit 9.2%. Now it is reduced to 6.8, 6.9, 6.4. No need to remember the figures. I have said you have to remember the broad trend in the reduction of deficit. Now this is primary deficit, effective revenue deficit reduced. This is revenue deficit. This one, red one is revenue deficit. Okay, so this one is latest, but even you go through the last decade trend of fiscal deficit, and you can see fluctuating trend. Okay, fluctuating trend. So if there is a statement like fiscal deficit of central government is increasing consistently over past 5 years, so it's not a correct statement. Okay, see the FRBM targets. Revised targets are 6.4%, revenue 3.8, primary 2.8. Okay, just have a brief idea. Okay. See, next question. With reference to the union government, consider following statements. Department of Revenue is responsible for the preparation of union budget that is presented to the Parliament. No amount can be withdrawn from Consolidated Fund of India without authorization of Parliament of India. All the disbursement made from public account also need authorization from Parliament of India. We have to choose correct statement. Okay, so maybe not possible you to remember which department prepares budget, etc. But we can go for remaining statement. No money can be withdrawn from Consolidated Fund of India without authorization of Parliament. Correct statement. So that's the key feature of Consolidated Fund of India. We cannot withdraw money without approval of Parliament. Now read third. Same condition is applied for public account also. It is correct. Is it correct? No. The money from public account can be withdrawn with executive action. So eliminate 3. We are with only see 2 options, 2 only or 1 and 2. The first statement is wrong. Department of Revenue is not responsible for budget preparation, but Department of Economic Affairs. Okay, now see, this is question in 2015. Now in year of 2010, UPSC asked single line question, which among the following department prepares union budget annually? And there were options like Department of Revenue, Department of Economic Affairs, Department of Financial Services, and all other options, remaining one. So had you solved that 2010 question before attempting this 2015 exam, then you could have easily marked this statement as wrong. So that's the benefit of solving previous year question. See, 2010, which department prepares budget? The same thing is repeated in statement 1 also. Same pattern you can observe in every subject. Okay, so correct answer is 2 only. Next question. Which, with reference to union budget, which of the following are covered under non-plan expenditure? This plan expenditure and non-plan expenditure. Plan expenditure is those expenditures mentioned in 5-year plan. Non-plan expenditure which aren't mentioned in that 5-year plan. This has been done away from 2017 because Finance Commission has been abolished and replaced by Niti Aayog. But still, this question is from 2014. Let's solve this. The reference to Union budget which are covered in non-plan expenditure. Defense expenditure, yes. Interest payment, yes. Salaries, pension, subsidies, all are covered under non-plan expenditure. If you want to read more about this, then go through 12th macroeconomic NCERT. Okay, so correct answer is C. 1, 2, 3, 4. Let's see more regarding this important thing. This is the revenue expenditure. Suppose question come, under which category of revenue account the expenditure is maximum? Defense, interest, and etc. So our general tendency is what? Defense expenditure would have been maximum, but that's not the case. See here, revenue expenditure, salary, pay and allowances, pensions, interest payments, major subsidies, and defense services. Now see, expenditure in lakh crore, salaries 2.52, pensions 1.90, interest payment 8.10 lakh crore, major subsidies 3.35, 2.2, defense services. Which one incurs maximum? Interest payment. So it is top to bottom order. Interest payment, then comes what? Interest payment, then subsidies, then salaries, then defense, then pension. See, maximum expenditure under revenue account is incurred upon interest payments. Okay, no need to mug up figures, facts. See the relative trend, see the decreasing order. Question can be asked. Okay, now see the trend in revenue expenditure and capital expenditure. Conceptual question can also be asked. Which among the following deficit is harmful for economy or not desirable? The answer is revenue deficit. Okay, so actually under original provision of FRBM Act, there is also provision to eliminate the revenue deficit. Okay, see that trend is capital expenditure, fluctuating trend. Sorry, revenue expenditure, fluctuating trend, capital expenditure, fluctuating trend. There is divergence right now in 2021-2022. Okay, now one more important thing. As per RBI report on finances, two-thirds of capital expenditure incurred by state governments and 1/3 incurred by central government. Okay, very crucial point. Remember, see major subsidies. See which one is maximum? Food subsidy, then fertilizer, then petroleum, other. But see the trend, food subsidy has been reduced but still dominates the basket. Then fertilizer, then petroleum. See, food subsidy is way more than petroleum subsidy. Okay, go through this trend. Food, then fertilizer, then petroleum. Okay, very important. See, have a look, brief look on it. How rupee comes from, rupee, where the rupee comes from, and rupee goes out. Pause this and take screenshot. Calmly go through it. See, rupee comes from maximum 35% borrowings and liabilities. Then GST 16%. Then corporation tax 15%. Income tax 15%. Excise 7.55 custom and non-tax revenue. Similarly, here also maximum interest payments 20%. Then state share of taxes 42% as per finance commission. 15% central sector scheme, other expenditure, subsidy, etc. So having brief idea is necessary, because direct question won't come, but having brief idea will help us to solve other MCQs or at least eliminate statements. Okay. Next. In India, deficit financing is used for raising resources for. Such question we have to choose most appropriate answer. See, read B, C and D. Reducing foreign debt, adjusting balance of payment, redemption of public debt. Not correct. Economic development. India is a developing country. We are a welfareistic society. Why will we incur deficit? Obviously for economic development. Okay. Reducing foreign debt, balance of payment, public debt. Wrong option. Again, detailed understanding of this, read 12th macroeconomic NCERT. There is a extract on debt sustainability, deficit sustainability, how much deficit should we incur and all other things. Okay, now see this question. Which one of the following appropriately describes fiscal stimulus? 2011. It is a massive investment by government in manufacturing sector to ensure the supply of goods to meet the demand surge caused by rapid economic growth. It is an intense affirmative action of the government to boost economic activity. See, it is government's intensive action on financial institutions to ensure disbursement of loans to agriculture and allied sectors to promote greater food production. It is an extreme affirmative action by government to pursue policy of financial inclusion. Which one is correct? Option number 2 is correct. It is an intense affirmative action to boost economic activity. The other statements have specificness, like there is manufacturing sector. Third one is, see, first option, manufacturing sector to meet demand surge caused by rapid economic growth. Generally, during fiscal stimulus, there is a recessionary trend. That's why government has to take fiscal stimulating options. First one is wrong. Merely merely marking correct option will not be useful. We have to understand why the remaining statements are also incorrect, because knowledge and understanding about incorrectness of the statements will be helpful for us in the upcoming examination to eliminate statement and get options correct. Okay, it is government's intensive action plan on financial institutions. Again, specificness incorrect. Extreme affirmative action or financial inclusion, again incorrect. See, this question is asked in 2011. Now one homework for you. Go through UPSC question paper of 2010. 2010. In 2010 there is a question: which among the following are the measures taken by government during fiscal stimulus? Fiscal stimulus. And there are options like tax cut, public expenditure, and other things. So your homework is go through UPSC question paper 2010 and find out this question. What is fiscal stimulus? Okay. So now with fiscal stimulus, we also need to understand its counterpart is fiscal consolidation. What is consolidation? This is screenshot from OECD website. Fiscal consolidation is defined as concrete policies aimed at reducing government deficits and debt accumulation. These consolidation plans and detailed measures are given as percent of nominal GDP. All measures are quantified to the extent not required primary balances. Okay. Spending reduction. We have to see, take screenshot and go through calmly. But what is the key pillar? That is in fiscal stimulus, expenditure by government up, fiscal consolidation, expenditure down. So you have seen earlier 2010 they asked fiscal stimulus and then again extended the theme. So we must be aware with its counterpart also. That's why I gave this screenshot to you. Okay, so understand fiscal consolidation. Now while solving question of inflation, I have told you that we will see counter-cyclical fiscal policy and pro-cyclical fiscal policy during our lectures of budget and taxation. So let's discuss that briefly. Okay, because it is important from exam perspective. Fiscal policy by government. Counter-cyclical, pro-cyclical. Counter-cyclical, during recession, what will we undertake? Fiscal stimulus. During boom or inflation, which is the appropriate action? Fiscal consolidation. Again, in pro-cyclical, the opposite. Recession, you have to undertake fiscal consolidation, and in inflation, fiscal stimulus. This is the key characteristic. Notice this fiscal stimulus, you have to increase the economic activity, tax cuts, public expenditure, okay, and consolidation, tax rates up, public expenditure down. Okay, so remember this counter-cyclical and pro-cyclical fiscal policy actions, because these keywords are often mentioned in economic survey, and like we discussed in monetary policy lecture, UPSC asked questions regarding expansionary monetary policy, contractionary monetary policy. It didn't give that interest rate are increasing. Instead of it gave contractionary monetary policy. So we should decipher its meaning also. Okay, so whenever you will encounter through these words, you can now understand their meaning. Fiscal stimulus and consolidation. Next question. Which of the following effects of creation of black money in India has been the main cause of worry? Again, choose most appropriate answer. Diversion of resources to the purchase of real estate and investment in luxury housing. main cause. We have to choose main cause. This can be also cause 1. Okay, investment in unproductive activities and purchase of precious stones, jewelry, gold. It can be cause, but is it a main cause? No. Let's read all statement first. Large donations of political parties and growth of regionalism. Now read it. 4. Loss of revenue to the state exchequer due to tax evasion. This one is correct. So the black money isn't accounted. How can it be taxed? This is the main reason. Because already we have low tax to GDP ratio. We saw it in earlier question. Low tax to GDP. Almost 10 to 11%. Okay, so tax evasion is the main cause. This is the answer. Okay, now last question of this session regarding FRBM Act. Okay, before solving this question, let's briefly discuss FRBM. This is extract from 12th macroeconomic NCERT. Very important from UPSC perspective. Okay, read. The Act mandates that central government to take appropriate measures to reduce fiscal deficit and revenue deficit so far as to eliminate revenue deficit by 2009. Build adequate revenue surplus. It requires reduction of fiscal deficit by 0.3% of GDP each year. Okay, and the revenue deficit by 0.5% each year. Actual deficit may exceed targets specified only on grounds of national security, natural calamity. Central government shall not borrow from Reserve Bank of India except by means and advances, ways of means and advances. Okay, to meet temporary excess of cash disbursement. Ways and means advances we discussed in earlier lecture. Reserve Bank of India must not subscribe to primary issue. This is from earlier, but understand the broad and core features. Measures to greater fiscal transparency in fiscal operation. Now, seventh point is important. I will show you why this is important. Central government to lay before both houses of parliament 3 statements. First one is medium term fiscal policy statement. Second, fiscal policy strategy statement. Third, macroeconomic framework statement along with annual financial statement. These documents in budget, quarterly review, etc. Now, I mark this option important. Now see this question in 2020. This is UPSC Civil Service question in 2020. Along with the budget, Finance Minister also places other documents before the Parliament, which include macroeconomic framework statement. Aforesaid document is presented because this is mandated by provisions of FRBM. D is the correct answer. Very simple, straightforward answer. 2 marks immediately within 5 seconds. Had you revised important provisions, remaining time you can spend on difficult questions. Okay. Now see, all this target wasn't met during 2008-9 mainly due to global financial crisis. Global financial crisis. And in 2009, target suspended. So government come up with encasing committee. See the important recommendation. Encasing committee asks government to give more priority to debt. The committee suggested using debt as a primary target for fiscal policy. Debt to GDP ratio should be 60%, center 40%, state 20%. Okay, to achieve target, so go through this. Establishment of fiscal council, role of fiscal council, go through this. So question can be asked, fiscal council was recommended by which committee? There is FRBM encasing committee, FRBM review committee. What is fiscal council role? Given here. Question can be asked on this. Last point is this one. Fiscal deficit target by 2023. No need to memorize. Just go through this. Okay. Again, this recommendation we have seen. Now see the exceptions. Go through carefully. National security, calamities, severe collapse of agriculture, far-reaching structural reforms in economy, fall of real output. Now let's solve the final question and wrap up this session. See, I have gone through these points quickly, but you can pause the video, take screenshot and read the screenshots. Okay, so we have seen this. Fiscal Responsibility and Budget Management Review Committee reports recommended debt to GDP ratio 60%. Correct, we have seen in its screenshot by 2023, comprising 40% of central government and 20. Correct statement. Central government has domestic liabilities of 21% of GDP as compared to that of 49% of GDP of state. Will it be possible? On one hand, we are allowing central government to borrow 40% of debt and states 20%. So who will have more liability? Obviously, central government. Second statement is wrong. Eliminate 2. So 1 and 3. Third one is, as per Constitution of India, it is mandatory for a state to take central government's consent for raising any loan if the former owes any outstanding liabilities to the latter. Correct statement. See, 1 and 3 is correct statement. Revised target of FRBM will be published in this year's budget. Our faculty at Lokayan Academy will discuss budget also. There you will have revised targets of FRBM. So that's why I haven't mentioned specifically targets here and discuss it. I just discussed trend. Okay, so that's all about today's session regarding fiscal policy. If you like the lecture, please like, comment and do subscribe to our YouTube channel. Thank you very much.